Why is Canada winning the global energy war? Right now, with the US and Israeli airstrikes on Iran and the blockade of the Strait of Hormuz, the entire Middle East has effectively become a battlefield. This blockade has starkly exposed the fatal vulnerabilities of our global energy supply chains. But as global capital panics, markets are turning their attention to a geopolitical safe haven: Canada. As the world's fourth largest oil producer, Canada is rapidly emerging as a critical alternative. Today, we look at why Canadian assets are in the spotlight and the reality behind their expanding oil and LNG exports. Let's start with the macro environment. Generally, when commodity prices spike, the currency of the resource-exporting nation appreciates. Driven by soaring crude oil and natural gas prices, the Canadian dollar is positioned for strong upward momentum. But the real story is in the Canadian stock market. Look at the S&P/TSX Composite Index. Unlike the tech-heavy US market, the TSX is anchored by value. Financials make up about 30% of the index, and the energy sector accounts for 20%. This unique structure acts as a powerful growth engine during a commodity supercycle. In fact, the Canadian stock market has shown massive returns since the beginning of 2025, up over 30% year to date, peaking at an impressive 55%. For investors building a resilient portfolio, blending US equities with Canadian exposure is a strategy worth considering. For example, pairing the SPY ETF with the EWC ETF, a US-listed, unhedged ETF that tracks the Canadian market and directly benefits from a stronger Canadian dollar. But before we declare Canada the undisputed king of energy, we need to look at a harsh reality: infrastructure. Even though the massive Trans Mountain Pipeline, or TMX, expansion is complete, allowing it to handle 890,000 barrels per day, severe logistical constraints remain. The problem isn't the pipeline, it's the port. The Burnaby Export Terminal simply cannot accommodate very large crude carriers, known as VLCCs. It is physically limited to Aframax-class vessels, which hold about 800,000 barrels per shipment. Because VLCCs cannot enter, a significant portion of Canadian crude must still be diverted to export terminals all the way down in the US Gulf Coast to efficiently reach global markets. To truly command the global supply chain, Canada desperately needs massive upfront investments in deep-water export terminals. Fortunately, natural gas tells a different story. Enter LNG Canada. Commencing operations this year, this project is built on a true deep-water port, fully capable of docking massive state-of-the-art LNG carriers. Backed by a joint venture involving Shell, Mitsubishi, PetroChina, Kogas, and Petronas, it is already aggressively exporting to Asian powerhouses like South Korea, China, and Japan. So, what is the ultimate takeaway? The geopolitical crisis in the Middle East has undeniably boosted the appeal of Canadian energy. And while there are realistic physical limitations to exporting Canadian crude at a massive scale, the financial outlook for these companies is incredibly bright. Why? Because historically, the United States was the only export route for Canadian oil, forcing Canada to sell its crude at a massive discount. Today, the TMX expansion has finally created an alternative export channel across the Pacific. As this notorious discount narrows and global demand shifts away from the volatile Middle East, the net profit margins of Canadian energy firms are expected to improve considerably. A shifting geopolitical landscape creates profound macroeconomic ripples. If the opportunity arises, we will dive deeper into the broader economic growth potential of Western Canada, including the Greater Vancouver area, in a future video. Thank you for watching. Don't forget to like, subscribe, and visit the blog link in the description for more deep dive analyses.